don't just get fixated on cost of capital. 0% of the time have I seen the lowest cost of capital option be the best option for an early stage brand. A general rule of growing is like you're not fully optimized, right, across your P&L. You should try to improve it as you can, but you're not optimized. You're growing. You don't start harvesting and optimizing until you get to a certain size and maybe growth starts leveling out. And I've seen the same to be true with cost of capital.
You're listening to Ecomm Finance Experts by Finaloop, where we dive into e-commerce finance best practices with the sharpest minds in the game. We're joined here today by John Blair, founder of Grow CFO. John, thanks for joining us.
Glad to be here, man. Happy to get into some fun stuff, the nerdy finance stuff that gets me really excited.
Yeah, same here. Now, with that intro, so John is really a great voice and a really smart guy. So we're happy to be able to pick his brain and walk through some interesting finance topics today. So first of all, kind of just like a general question that I find interesting to speak about. When someone knocks on your proverbial door and you have a new client, what are like the most recurring or big issues that you see when you kind of first examine a brand's financials?
I would say there's three big problems that we encounter constantly. Not necessarily all three at the same time, usually some mixture of the three. First one, and shameless plug for Finaloop on this, but it's true. It's jacked up bookkeeping. And the problem with that is that when the bookkeeping is not sound, both from a timeliness perspective and an accurate, what's called accrual accounting perspective, you can't analyze margins accurately on the P&L. And so you can't really assess where the levers are to improve profitability, and you can't analyze the balance sheet accurately, which means you can't analyze the levers that are needed to improve cash flow. So jacked up bookkeeping is the first one. The second one is in a lack of sophistication around understanding the impact of ad spend on profitability. Either an overly simplistic view of how ad spend affects profitability, or just don't really understand it at all. And really what it comes down to is like a misunderstanding or a lack of understanding around contribution margin impact of ad spend. So that's the second thing. And then the third thing is just mismanaged balance sheet. And really in the D2C world, because there's usually, depending on the size of the brand, very little to no accounts receivable. It's not necessarily AR mismanagement, it's inventory and accounts payable mismanagement. So messed up bookkeeping, not understanding ad spend's impact on contribution margin and ultimately profit, and a mismanaged balance sheet.
Interesting. And I guess first stage would be cleaning up the books, then kind of diving into those and other metrics and seeing where they could fix things up and improve the metrics.
Exactly. I mean, sometimes the books, even when they're messed up, they're good enough to get some quick wins but a lot of times they're so messed up, like that has to happen first. The cleanup has to happen first, and then and only then can we start advising on how to improve profit and cash flow.
Right. That makes a lot of sense. I personally think contribution margin is one of the most important metrics, and it's a little overlooked sometimes and doesn't get enough focus versus ROAS or other marketing based metrics.
Totally. Yeah, and the other thing too, this is a big emphasis that we've been pushing on this a lot with our clients in 2025, is breaking contribution margin down into dollars of contribution from new customers versus profit contribution from repeat customers. And so we have a series of metrics that we kind of spread for brands to help them actually see not just total company contribution margin for the month, but how much of that was new customer and how much of that was repeat customer. And it's very, very enlightening in terms of understanding how hard you can. It's really enlightening in terms of basically how high of a CAC or acquisition cost can you actually afford. It's basically impossible to answer that question without looking at contribution from new versus repeat. So that's a big thing that we're really pushing to help our clients understand this year.
Yeah, that makes a lot of sense. splitting up the contribution margin. Kind of moving down the P&L to interest expenses and all kinds of debt financing. Everyone knows that ecom is difficult enough as it is with all of the inventory heavy businesses and financing, which is necessary at multiple stages in the company's lifetime. So maybe just a few words or thoughts on what kinds of instruments are out there for brands and how you recommend looking at them.
Yeah, so debt options or lenders are probably in my opinion, some of the most active cold outreach, cold outbound salespeople out there, because that market is very commoditized. There's a lot of different options, right? And so founders are getting hit up constantly. I would say who they're getting hit up the most frequently by, at least from my perspective, are MCA lenders. So that's like your Shopify Capital, Wayflyer, Clearco. And then I'll call them alternative lenders, meaning non-bank lenders like Settle, Flexport Capital, and they operate on more of like a buy now, pay later structure. And then there's actually this new group of lenders. I'm really not very fond of them. They say they position themselves as not MCAs, but they actually are MCAs. And so you got to be careful about that. And then I guess the third, and it's actually less in the lower to middle market where we serve ecom brands, which I'd say is like 5 to 100 million in revenue. There are ABLs, asset-based lines of credit. They're less prevalent in the early stage, and they become more prevalent later on after you break into healthy 8 figures in revenue. So the most common ones that before you hit, we'll call it roughly 20 to 50 million a year in revenue, are the buy now, pay later, Settle and Flexport Capital, and the merchant cash advance options.
Right. There's a lot of talk in the industry, are MCAs good or bad or necessary? Right? They end up having very high APRs when you actually do the math and break down the whole debt structure. Any thoughts on that about MCAs in general, and are they good or bad for the industry?
I used to think that just like hands down, black or white, MCAs are evil, right? I don't think that anymore. Now, to be clear, it is, I believe it, you should use it, generally speaking, as a last resort. But and here's why. We've yet to really find an ecom brand that doesn't have a true what's called revolving debt need, meaning that you use it, you pay it down, you use it, you pay it down, you use it, you pay it down. MCAs are terrible for that because of how expensive they are to use, to draw, pay down, draw, pay down. Furthermore, the reason why they don't match the payback, the payback schedule doesn't match the use of the asset that you're financing. That's like the key thing that people don't realize. Not only are they expensive, you pay it back before you sell the inventory that you use to finance it with. So you're stuck needing to take another one. Other options out there allow you to hold on to that debt capital for longer and more match it with the number of days you're holding the inventory so that you're paying it back more in line with selling it. So that's actually, it's cost plus the fact that it doesn't line up with the asset, the cash flows of the asset that you're purchasing, in this case, inventory. But I have observed there are some times when it may make sense to use one as a last resort if you have no other options. 2, if you truly have a short-term need and you don't have the time to do all the underwriting, right, for some of the other options that are out there, because you can click a button, fill out a few things, Shopify Capital, money's in your bank account. So if you do have a short-term kind of somewhat emergency or urgent need, I've seen that it can be okay to use, but you don't want to be using it on a revolving basis again and again and again, because you'll be paying 20 to 50% APR. I still haven't found one that's 20. I'd say more like 30 to 50% APR. And you'll pay it back before you sell the inventory that you use to finance it. So you're going to go, shoot, now I'm stuck in the same situation again, and I paid all this interest for it. So I will say one other use case is to use it on top of another debt facility. I've done this with a brand before where they had an ABL, and the ABL lender let them take Shopify Capital on top of it for a period of time because Shopify Capital is unsecured and has no rights to the assets, and that lender had a full asset lien. So they were protected, and they let them take Shopify Capital as a second layer. So there are some ways to get creative, but again, situationally and more as a last resort.
Right. That makes a lot of sense. And I think because it is more of a last resort bet, and because the underwriting is so lean and doesn't really dig so deep into your books, that's why at the end of the day, the interest rates are crazy, just because it's a high risk
Totally.
loan. Right. So it's not that it's not justified. It is. The interest represents the risk. The question is, do you want to take
Totally.
that risk, or do you want to take a better kind of financing route?
That's a really good point. Is that like I don't think MCA lenders are evil, right?
Yeah.
I agree that like the cost of capital or the cost of the interest is aligned with the risk they're taking by providing an unsecured loan. Going on the far other side of the spectrum, like in the US, SBA loans, which are government backed, right? Which brings the interest rate down. Those are kind of those are like the cheapest cost interest cost loans that you can get, but they come with hefty lender protections and then ultimately company and owner liability. So you have to decide. I actually do have a few brand founders who are like, I don't care that Shopify Capital is so expensive. I don't want to be on the hook for anything. So they're making their own risk adjusted decision for their own personal risk. So as long as you understand what you're getting yourself into, if you decide that that's best for your business, that's not right or wrong, but just understand these different dynamics of like what merchant cash advances will and won't do for your business.
Right. I've heard people say, and I think there's a lot of truth to that, when you take an SBA or any kind of loan with a personal guarantee, you're already an Ecomm, which has very low differentiation, is very high risk, and you're adding personal guarantee on top of that. That's like leveraging leverage. That's really high risk. So you have to be very comfortable, even if you're paying lower interest, with that kind of risk appetite.
Well, and another thing to consider too, this is not unlike the contribution margin concept of like contribution margin ratio, which is a percentage of revenue versus dollars, right? In this case, we're talking about interest percentage as an APR, which is a percentage of not revenue, but of proceeds that you've borrowed versus interest dollars. So like, let's say that you can borrow money from Shopify Capital for $6,000 in interest, and that represents a 50% APR. 50% APR seems crazy, but if you're investing it in something that's going to make $12,000 in margin, it's still a profitable move to borrow money at 50%, right? So you do have to, a CFO can really help you think through not just the percentages, but the incremental dollars, because the incremental dollars are what actually hit the bottom line.
Right. Yeah, I always think of it as like when you run a business or in general, to think of everything from as an investor, right? What's your return you're getting and what's your investment, and where's your IRR or XIRR? And if you're making more than you're paying and that's your only alternative, then it might make sense.
Totally.
Right. And let's say you're an earlier stage brand that you don't yet qualify for any of the lines of credit that are based on inventory. Are there any significant options out there other than an SBA or an MCA kind of instrument?
Yeah, that's a really good question. I mean, there's obviously a lot of nuance, but I'll give the kind of the general progression that we see for a brand that's growing steadily. They're in the early stage, but they're growing steadily. It's like you start with your own equity capital, or the reason I'm saying your own is because most of the brands we work with are bootstrapped and owner funded, right? As opposed, or like founder funded, as opposed to taking outside capital. But like you have initial equity capital wherever it comes from, and then you can choose to either go MCA or grow within retained earnings, meaning the profitability that you retain in the business. You have to like, to do it sophisticated, you have to sit down and kind of run a quick financial model, which a CFO can help with, to like go, okay, how fast can I grow if I borrow Shopify Capital versus if I grow based on my own earnings, right? And so but then you eventually can get to a point where you can qualify for like the buy now, pay later. I usually see that as like the second phase. So that's, again, the Flexport Capital, the settle. You're still not qualify for, a bank line or maybe even an ABL, but those buy now, pay later, where like they pay your vendor directly and then you pay them back 90 days later, you can actually borrow a lot more capital and get a lot closer to matching that with the asset, the inventory that you're buying. So usually you graduate to that, And then after that, it can be a mixture of those buy now, pay laters and some sort of revolving line of credit. It may be an asset-based line with a non-bank lender. That's usually who we see first, because going to a commercial bank, they just don't, they're so risk averse and they're heavily regulated in the US. They can only give you so much capital as a percentage of your inventory value. That non-bank ABLs will give you a higher percentage, or what's called advanced rate. So usually a higher growth brand is not going to go to their commercial bank until they, honestly, this is generally not until they have AR in the mix and they expand into retail and they have like significant AR from like Target or Walmart or whatever. That's when a commercial bank line really starts to become a lot more likely. So it's like kind of MCAs and internal capital, or internal equity capital, buy now, pay later, non-bank ABLs, and then eventually commercial bank line of credit. That's generally the progression that I see.
Interesting. And buy now, pay laters, what are the effective APRs there?
So it can depend on several factors, but with like all in, right? All in cost of capital, including any fees and whatnot, we'll call it roughly 14 to 18%. You can go, it can get a little bit higher than that or a little bit lower, depending on your ability to negotiate and how excited the lender is, but we'll call it roughly 14 to 18.
Got it. So it's kind of walking through the numbers. So when you're starting out, you're either funding yourself with your own equity / retained earnings, or taking an MCA at some point. And then when you hit, like, it's buy now, pay later, so it's like 2-3 million revenue, something along
Yeah,
those
a few million in revenue.
And then once you hit 5, you can already start looking at lines of credit or asset-backed loans. And the more you move up the curve, the more you can just go into traditional banks, then get more of the regulation, but on the other hand, better effective interest rates.
Yep. And just keep in mind that we have some brand founders who have offers from their commercial bank and they don't take that offer and they stick with a non-bank ABL because the non-bank ABL is offering a higher advance rate and is removing some of the personal liability, like there's no PG, right? And so we have brand founders who are like, hey, you know what? I could get 9 or 10% from JP Morgan Chase. I'm getting 15 from this non-bank lender, but no PG and a higher advance rate. I'll pay the 15 to not have the PG and to be able to borrow more because we're growing really fast. So I think what I was just doing a training on this in an Ecomm brand founder community last week. And what I was trying to get them to understand is like, don't just get fixated on cost of capital,
Right.
because especially in the early stage, cost of capital, the lowest cost of capital I've never seen, 0% of the time have I seen the lowest cost of capital option be the best option holistically for an early stage brand. It's almost kind of like, when a general rule of growing is like, you're not fully optimized, right? Across your P&L, you should try to improve it as you can, but you're not optimized. You're growing. You don't start harvesting and optimizing until you get to a certain size and maybe growth starts leveling out. And I've seen the same to be true with cost of capital on debt instruments.
All right, interesting. That makes a lot of sense. And are the rules, I know some like ABLs have rules when they count inventory, when they don't, if it has to be in the US or not. Are those different if you are a bank lender versus a non-traditional lender?
Yeah, that's actually a really good question. So generally speaking, banks in transit inventory, always ineligible. Again, I say generally speaking because there are edge cases, right? But they're still going to protect themselves somehow. Like edge case, like, oh, you have a $500,000 what's called over advance that you want for in transit inventory. Well, the owner of the brand is banking with us personally, and we have enough of his personal assets that will put a lien on those to give you those over advance. So there's no free lunch with the bank. Let's put it that way, right? No ABL lenders love in transit because it's not easy to foreclose on, right? And take custody of it and liquidate it. If it's on a ship, I mean, who knows? Like, it could not get cleared through customs. There's all kinds of risk, right? The ship could sink and then they got to file an insurance claim. It gets delayed in customs. They can't just go to the warehouse and grab it and sell it, right? So they view it as riskier. Back in the day, when I was at Guardian Bikes scaling that brand, we'll call it like during the COVID bubble, like you could get ABL lenders to give you all kinds of stuff. I got in transit inventory all day and I got super high advance rates. After that bubble burst, they really tightened down. Some of those lenders got into financial trouble, and had, portfolio losses. And so now what you can generally get with an ABL, a non-bank ABL, is you can get them to do in transit on a case-by-case basis, and they'll usually charge a premium on that advance, right? But what I've seen successful is layering two debt products. So like Flexport Capital will come in and they will pay the vendor and float the in transit, and they'll have an agreement with the ABL lender that like there's no double dipping. They'll pay the vendor, and when that inventory gets to the warehouse, the ABL, a draw has to be taken on the ABL to pay back Flexport Capital, and now you can draw the advance rate from the ABL lender. So you can't double dip and borrow from both on the same tranche of inventory. That is a structure that we have successfully put in place. I've successfully used numerous times as ABL lender for domestically held on-hand inventory, and a buy now, pay later vendor to finance in transit inventory.
Very interesting. That's a good structure. Are there any other assets that would not, other than in transit inventory, which would not be taken into account from the bank's perspective?
Yeah, I mean, there's usually, boilerplate in all these loan docs, there are what they call an age out exclusions, meaning like if you're looking at inventory as the borrowing base, inventory aged over a certain number of days becomes ineligible, because again, from the lender's perspective, there's a risk that you're not going to sell that inventory, right? And same thing on the AR side. They if part of the formula for your ABL is 80% of AR, you can borrow up to 80% of AR. Usually there's an age out where beyond 90 days, it's negotiable. The standard is 90. They'll put that in the agreement, 90 days, anything beyond 90. But you can negotiate with them. You can sit down and show them in your data, like, hey, this happened to me at Guardian. We had an ABL with a 80 or 85% advance rate on AR, and we were selling direct to Amazon Vendor Central at that time. And Amazon's payment terms were 90 days, and they don't pay exactly on day 90. They pay on Fridays. So sometimes you get paid a little early, but sometimes you get paid as much as 7 days later, or even a little bit more, just with funds clearing, right? So like a lot of times it's 100 days, but they're still technically paying on time. And we sat down with the lender and we said, you can't age everything out after 90 days. We get paid in 100 days. And this is Amazon. Look at we pulled the data. We're like, they always pay us, right? So like, you need to extend this to, I asked for 120 days. They push back. We met in the middle at 110. So just know that like, you're going to get served a boilerplate agreement, and you have to go make the case. And again, this is a place where a CFO who's seasoned in negotiating these deals can help you, is like, you have to make the case for like, that doesn't fit our business. We need you to like give a little bit here, because here's how our business works. And if you can make a case for it, a lot of times lenders will move the line a little bit to make sure it works for your business. So that's an important point.
All right, that is a good point. And you mentioned that it was Amazon paying it. Do they kind of like rank the ARs, and if it's a smaller shop, give you a smaller advance or take less into account? Would that kind of be part of the calculation as well?
Yeah, like again, another great example, like they boilerplate, I think if I remember correctly, they give us a 75% advance rate. And we're like, dude, this is Amazon, man. We pushed them on a 90% advance rate, and they gave us 85. But we pulled data to show them how they had been paying us like clockwork. Other vendors, if it's a strong retailer, Target, Walmart, there's a good chance, or actually there's probably 100% chance that ABL lender is lending to other brands who get paid by Target and Walmart and Amazon. So they know that they're good payers. They're not like unaware of that. And so but yes, I know other, not e-com brands, but in like a previous life, I was in the wholesale manufacturing world, and we had a bunch of small dealers, like 250 dealers on our AR report. You can get financing for those, but they're little mom and pop shop dealers. It's a lot harder to push really hard on an advance rate. that's really high because they're just not as credit worthy type, customers. So yeah, that definitely matters.
Right. In a previous life, I was involved in life insurance and investment in life insurance assets. And at the end of the day, it's all about the underwriting and the risk and all of these assets.
100%.
Right.
100%. And that you've brought that up multiple times now, right? Like thinking about risk versus return. That is a classic. It's hard to remember that as a brand founder, right? You have so many different things that you're trying to keep tabs of. All decisions are not equal, right? And not all investments are not equal. If you want to take away one thing as a brand founder in terms of like how does finance work, it's just a couple things. One, risk versus reward, right? Or risk versus potential return. The time value of money, a dollar today is not worth the same as a dollar tomorrow. It's worth more today, right? And then capital is finite. So there's trade-offs. So a dollar spent here means a dollar can't be spent over here. If you can remember those three things, that's the basis upon which all finance is built upon.
Right. Okay, now kind of segueing out of finance and debt just into like current events, tariffs. I was sure, like I was discussing this a lot with people in the past couple of months. I was sure that tariffs were just like a play, not when like it actually happened. It actually happened, and it's like a really big deal. Like other than like the S&P crashing and everything, like what's your take on that, and how can brands kind of get ready or change their supply chain or operating methodologies in order to take this into account?
Okay, so this is obviously really tough. I was the CFO and COO at Guardian Bikes when the first Trump tariffs were enacted. And at that time, we were making our bikes in Shenzhen, China. And it's not, look, there's no playbook out there. There's no manual to go look up this stuff, right? Like you can look up the formula for contribution margin or weighted average cost of capital. You can't look up the formula for navigating this, right? And so I have a few pieces of advice from the experience that we had at Guardian Bikes going through this back in whenever that was. Was that 2019 or something like that? Either way, with COVID, it's like hard. All the years like melt together, right? But I'm like, what year was that? But anyways, don't panic. That's my first bit of advice. When this happened the first time, bike companies were like freaking out, and they were like trying to get production done in like other Southeast Asia countries and like Cambodia, and Cambodia was a big one, and other countries in that area. And Guardian didn't do that. And here's what's interesting. Our competitors were like running around like chickens with their heads cut off, trying to get the supply chain moved around to save some money. Meanwhile, you know what happened? They started having issues with inventory availability. They were like, it wasn't so easy for these less developed countries. Like I've been to China. It is a manufacturing powerhouse. Every storefront has a factory in it. Like there's like a storefront that sells something else, but they have an injection molding machine like in the back. Like it is so developed, right, from a manufacturing standpoint. These other countries are not like China. Doesn't mean you shouldn't move, but it's a big decision to move your supply chain. So like you need to look for other ways to be resilient while you're trying to figure out the supply chain, like moving around your supply chain. If you go move it and then and think about the time sink into that, and then this stuff gets repealed, what did you do that for, right? And so it doesn't mean you shouldn't look at options and trying to create optionality. I think you definitely should, but be careful like panicking, right? The other thing is you got to sit down and talk to your vendors. We have several brands that we work with at Free to Grow CFO where we've been like, hey, what's your concern about the tariffs? And several of them be like, hey, I sat down and I talked to my supplier and they dropped the price enough to overcome the tariff. Or they said, do you want to split this 50-50? The Chinese vendors don't want to lose the business either, right? And so it's better for you to sit down and say, how can we weather this storm together while we wait and see what actually happens? Because that's the biggest problem. We don't know what's going to actually happen. They could go away. Some of them could stick. It could get worse, right? So if you think about it, what can you be doing to explore other options, right? Other supply chain options, but what can you do to partner with your existing supply chain partners to try to get this all figured out? And then additionally, look at your P&L, look at your balance sheet, and really think through how you can make sure that you are as resilient as possible in the way that those things are structured. One thing it could mean is, hey, let's have a year of slower growth just while we figure out this uncertainty. Not wipe out our growth, but let's slow down a little bit. Let's put less pressure on the supply chain and how much inventory we have to purchase. Make sure you're lean in terms of overhead. Like the modern ecom brand does not have a massive full-time in-house team, right? They use tech tools like Finaloop and the myriad of other, tech tools there are to run an ecom brand, and they work with fractional, marketing agencies, CFO agencies like Free to Grow. Like, stay lean, right?
Yeah.
And so I think those are probably like the two biggest pieces of advice that I can offer at this time.
Right. Okay. Those are good points. And I guess time will tell. We'll see where things develop. It's definitely interesting. I end up writing content pieces, and then like 3 hours later, I need to like change the entire thing. It's like throw it not relevant anymore.
It's tough, man. Yeah, I know. It's like when you're writing about current events that are changing so fast, it's definitely kind of a little bit of a roll of the dice of how long that will stay relevant for,
Yeah. Sometimes it's a matter of minutes. All right, this has been a lot of fun. Thank you very much. If anyone wants to find out more about you, about Free to Grow, where's the best place to look for you?
For sure. So 3 places. One, follow me on LinkedIn, John, Jon, Blair, where I'm putting out several helpful tips on how to scale your profit-focused D2C brand every day. Check us out at freetogrowcfo.com. And if you want more awesome conversations, one of which is with Leo, the founder of Finaloop, several months back, about how to scale a profit-focused D2C brand, we've got a podcast as well, the Free to Grow CFO podcast, which you can find on all major podcast distribution channels.
Perfect. All right. Well, thank you so much, and great speaking.
Thanks for having me, Jacob.